Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, March 8th, 2023. It's 12 minutes after 10 a.m., so the markets have been open for about 45 minutes. And what I want to do is an update and cover, really get to precious metals, maybe look at Treasury bonds, some of the other things that I didn't cover yesterday. There's no change in the equity markets from my last update, so not much to add. We're flat right now. The S&P is, teeter-totter in between slightly negative, slightly positive. It's not going to go anywhere, at least until Powell is finished speaking. Remember, he speaks again today. Speaking should have started now, and that has the potential to move the markets again. But I'm going to cover, what he's doing. If you missed the headlines, he came out more hawkish than market anticipated. That's what knocked the markets down yesterday. I truly believe a lot of what they're doing now is jawboning, but again, he set the stage to see additional rate hikes, so we'll see how much we get. But I'm going to show you a couple things in regard to currencies: gold, euro, the dollar, because that's what's caused a big move down yesterday in the equity markets and the precious metals, because that implies higher rates in the U.S. And so the dollar surged against the euro, which is its biggest component. And again, let me get to that in just 1 minute. All right, to recap, the key levels to watch on the market: S&P 500, you have a beautiful bear market downtrend line, which was taken out here. It recently back tested, as well as that key 200-day moving average, a blue line on this chart, which has capped pretty much every advance since the bear market really got underway. If you either kissed it and reversed right on the button, or took it out briefly only to see a rejection or a false breakout there. So the $1,000,000 question is, will the pop above the 200-day, this one here, the breakout in this back test, will it fail, or is it going to be a successful back test? Obviously, that's going to be bullish. By successful, I mean, so far, yes, we're above the back test, but we're in very close proximity. If the market pretty much gets off, it's able to rally and get above, much above this high. Remember, I've thrown out and still very open to that, what I call marginal new high scenario, where you slightly pop that. It would suck in a lot of longs, a lot of bulls. It would blow out a lot of shorts, and it would give us nice negative divergence. That's about the only thing lacking on this recent high right here, is you did have overbought conditions, but you didn't have any negative divergence, nor do you have to, by the way. It just those daily divergences really set the stage for the bigger moves in the market. So okay, so that's what we're watching, and again, it's a confluence of support right there. And to keep it very simple, you don't even have to have the lines up on your chart. Last week's low was a perfect, and I mean a perfect test of the 200-day moving average right here, the blue line, and the downtrend line. And so therefore, you break that. Now the downtrend line is going to come in a hair lower. So again, it's more of an incremental thing than an all or none kind of full short, hard short. And like I said, I lean that way. But until and unless that happens, it's hard to make a case to take big position and swing and trend shorts that you're going to hold on to and give wide stops, because those are the type of just to catch these major legs down. If you are not an active trader, to get the big legs down in a bear market, or even the big legs up on the counter trend rallies, you can't run a 1% trailing stop loss, 2%. You're going to get clipped out in the noise. So that's what I'm referring to try to speak to the strategy. And everybody's different. I'm still living in the world of the intraday charts right now, but very cognizant of and keeping an eye on those longer term, levels on the daily and weekly charts. So that's where we're at. And again, Powell's going to talk, so you're going to probably see some more volatility. He's already pretty much, said what he needed to say, that the market isn't going to be good for the stock market. And the common theme is that, the economic data, especially the job market, continues to be extremely resilient in face of these rising rates. But as I said, there's a lag time with everything. And I feel very strong that the longer and the higher rates, the longer rates continue to rise, the greater the chance all of a sudden there's going to be really that kind of flashpoint, if you will, where the economy just can't digest rates coming up so much from persistently low levels that we've had for a long time. So, all right, let's not overthink it here. Let's see what happens. Just know you're going to have probably more volatility. And again, if you're getting chopped up, I've been warning about this for weeks and even months now, where we're likely to grind around and swing. Typical swing traders and trend traders, so swing traders that aren't very active, would probably not be very happy. And that's I don't see how you could be, because you're right back to where we were, a couple months ago and around the beginning of the year, really almost late mid-January at least. Okay, so let's roll into the other stuff. Let's talk about gold, silver, because they've been moving. So what happened is Powell's remarks surprised just about everybody, especially the degree of his hawkishness. And you can see there was one of the biggest drops right there, and this is a euro US dollar pair, and it went and it took out the trend line. So I have to fully recognize that. That is a breakdown. Remember, this trend line was my preferred, I called it preferred swing target back here when we put in this this high right there, that little blow off top in the euro. That's where the dollar or the euro was rallying against the dollar. And gold and silver are going to move in line with this chart. So when the euro is rallying against the dollar, it means the dollar is falling, gold and silver go up, and likewise that's bearish for gold and silver, as was yesterday, of course. So here's a couple things. I'm going to get to some short-term charts and show you right now on the euro US dollar pair, as well as euro futures. We're pretty much at that previous reaction low. All along, even back here, I maintained, look, this was my preferred swing target, but there is a potential, and there still is, and it's not going to be good for gold and silver if we get it, that we may want to go on, the euro may want to go on and backtest that primary downtrend line. Now, it's quite a bit of ways below, and that's why it'd be hard to imagine gold and silver rallying. At best, sometimes the euro can fall, the dollar can rally. In gold and silver, if there's a strong enough demand for them, they can actually offset that, the impact of the currencies, but that's not going to be good. And the thing is, that's where if we get there, there's also good price support. That's where we might have a nice objective long entry. Now, with that being said, this is one trend line. And as I jump to the weekly chart, which I just did here, there's a different draw on it. Let me show you right there. If I come off these weekly candles, which I've done here, 1, 2, 3, see these first reactions, we're right there. So by that draw, we're at trend line support, and this is, longer term charts for the longer term, bigger picture of the trend supersede the shorter term charts. So I will say that. And I've had this line, I haven't even touched this line forever. Created that back in May of 2022, and that was the bottom of a it's now support again. It was a long-term, you can see a very long-term support / resistance zone. It's resistance when you're below it, but we took that back right here. We recovered it after that false breakdown, and that in itself was very bullish, as I mentioned, and that helps me formulate my longer-term outlook for gold. But that was a false breakdown, aka bear trap, and that should have much more bullish implications than just with that rally we've had there. So this is probably where we're going ultimately up here, and that's going to be good for gold and silver if and when we get there. All right, so that's still, just wanted to point that out, that yes, I have to say that we've taken that trend line out on the daily, and there may be more downside, but I suspect not. Let me show you why. A couple other boards. Well, let me just look at my 60. Well, here's our 60-minute chart. So you can see there we had a divergent low, and we had a little breakout there, and we made a marginal new, meaning just a ever so slightly lower low there, and we still have, you can see here, we have about equal lows on the PPOs I've just drawn and equal lows on the RSI against lower lows and prices. That is positive divergence. So you have positive divergence on the 60. And let me get to my Euro futures chart. That's E7. I'm going to refresh this. These guys were still in the March. These are going to roll soon. They may have already rolled. I had the March up. But either way, I'll use this. It's going to show you right here. You had a decent price support level there. You can see it was resistance, 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 breakout right there, back test, back test, back test, back test. And look at the trend line we have here on the Euro futures right there. Nice clean uptrend line with 3 distinct tags, reactions there, and so there it is. So you have a confluence of support. You still have the positive divergence, and ultimately the thing about okay, so what makes currencies move is a country's rates. Remember, currencies, the value of a currency is it's completely relative to other currencies, how they trade against it. That's why I like to look at the euro-US dollar pair. Euro is 57.6% weighting, by far the largest component in the dollar index. So, the dollar goes up or down in strength depending on how the other currencies that it trades against go. All right, so that's pretty simple stuff. And again, the impact on gold and silver is an unmistakable correlation just due to the fact that they're priced, at least the gold and silver we're trading, is priced in US dollars. So there it is. I've just spent 5 minutes showing you that, yep, okay, we broke one trend line the way I had it drawn, and then I draw quite a few others, and we're still above support. And the other takeaway is the fact that the ECB follows the U.S. And the ECB, European Central Bank, of course, they're the ones that set the rates over there. And let me show you this chart here. So this shows you here. And so, the markets had that big move because Powell came out very hawkish. I've been reading that the the ECB needs to raise rates, and I promise you they will. They follow the Fed. And you can see here clearly on this chart, this is just a policy rates, the Federal Reserve and the ECB showing you right there. I think you can see it on the chart. Here's their rates. So you can see, let me just grab a tool here, color this up. I need to color this so you can see it here blue. Okay, so the Fed is here in blue, and we started cutting right here. Cut, 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 cut. ECB was still behind the curve, and of course, what did they do? They got the memo a little bit later, and they followed the Fed down, right? This is an older graph, but you can, again, I just did a quick Google search. When I looked at this, I didn't even see that's through 2015. Same thing happened again, and they will follow. And one of the reasons they will follow is that their markets will be impacted by it. So if you go, let's do this. Let's go over here, and let's type in any European fund. Let's say Europe, and we have this European equity fund. I've got the Europe 250, or there's an ETF here. Here we go. This one, the iShares, there it is, the iShares S&P Europe 350 Index Fund. These are the 350 biggest companies there and over there. And you can see right here, I need to be on a daily time frame. What you're looking at is the euro right here, euro US dollar pair, or the euro in orange, and pretty much the European stock market. And you can do this again with any ETF, overlay them. And so when the euro is climbing, their markets climb. And when the euro is falling, again in orange, their markets fall. So what do you think they're going to do now, especially with the Fed rising? They're going to raise rates. So therefore, this is an opportunity, in my opinion, to buy back in gold. In other words, gold, silver, GDX, everything I've been bullish on. The pullback was a little bit more than I thought it would be, but not too much. Remember, I showed you before all along, GDX had good support here, broke out. There was no divergence. Now we're starting to get a divergent low now on this little thrust down. If we had an equal or marginal new low, technically that'd be a divergent low. And I told you before, 2612 is big support right there on GDX, that support level. I don't think we're even going to get down there, because I think everything I'm telling you now, the rest of the markets are going to figure out, hey, okay, as hawkish as Powell is now, yeah, the ECB is going to be right behind them, right on their heels, raising rates, or at least talking the hawkish talk. And so that's it. So I made the case, all right, that the euro is still at support. GDX is still, holding above the recent lows. We've rallied up. You can see here. It's at support here on the 60-minute chart, GDX, pretty much an equal low there. And again, you can extend the divergence like that and see you still have positive divergence. Very oversold too. If you look at the, let me change this color on this tool back to this. Extreme oversold reading on the 60. The last time we were this oversold on the 60 was right there. Did you want to buy or sell? Well, you wanted to buy at that point, not get shaken out. Time before that, we were well below the this 30 level. That's considered oversold right there on the RSI. And you can see, so this is pretty much where, even when you're in a downtrend, even a downtrend alone, you get a nice, at least a snapback rally. In an uptrend, that's unusual, rarely seen oversold reading. Okay, and like everything, don't fall in love with it. It's just one trade. No one should have all their eggs in one basket on any position or too much. So I'm just giving you my thoughts. So this was the divergent high here. This is where we sidestepped that, profited on the pullback, got out, shorted the miners and metals, got rid of our longs. There was our sell signal, and we came full circle, as I covered recently. We put in a little bullish falling wedge right there, which we broke out of, and there's a breakout, and all we've done is come back to test the breakout point, and we could certainly go a little bit lower. I'd be fine with that. 1794 is good support on gold. These are, again, GC gold futures. Looking at a 6-month chart with 2-hour candles. So whether we get that or not, I still like gold, and I think this pullback is an opportunity to add to it. And then silver, remember gold, gold's more of the flight to safety, but less volatile. Silver is going to move more in percentage terms up or down. Let me grab that chart. Not sure why it's not loading. Let me enter that again. Silver futures. Okay, it already rolled. My chart was on the March contracts. All right, that's not working for me here. It went away. Sometimes that's how this charting platform works. They roll and then your charts just vanish. All right, here. Oh no, never mind. It's not. I'm in the, yeah. Let me see what I have position wise. Yeah, I'm in the maze already. I already rolled. All right, so there's silver. Same thing. 6-month, 2-hour candles. There's your divergence. That's positive divergence, aka bullish divergence, still in place. We had a divergent low there. We started to rally, ran into resistance at about 21.27, and put in a marginal new. In fact, the only thing missing at that low right there on this 2-hour chart is we did not have positive divergence. We put a lower low there. Now we have positive divergence. So, all right, guys, that's it. Don't want to beat a dead horse. Liking the metals here. And for those reasons I stated, both fundamentally based on what the currency should do, and technically, of course. Technicals first and foremost need to, are the primary reason for me to take any trade. But when I do look at fundamentals and factor that in as well. So fundamentals would be the impact, again, of what I'm talking about with currencies and everything. All right, now keep this video short. The other thing I've been watching and trading lately, Treasury bonds. These are ZB, the 30-year long bond. There was a downtrend line, nice positive, aka bullish divergences there. Broke out recently, did a little consolidating, and we've just taken out that other high. So it looks like there should be some more upside in ZB. Again, that's the 10-year Treasury bond futures. That's what it looks like on a 60-minute chart. That's just zooming into what I showed you on the 2-hour candles. And then, the ETF is TLT. You can see the same thing there. 60-minute little wedge pattern, bullish falling wedge, positive divergence, breakout. These are potential targets here. I probably have to tweak these. I haven't updated this chart in a while. That would be the first resistance level there. This one should come a little bit lower, somewhere around there, and then potentially all the way up to this level here. The wedge really only projects about where we went. I'm not crazy about it. Been in the last couple days, but it's not a hard buy at this point. But either way, the near term drift looks to be bullish. And then when you go out to the daily chart, you can see we're right now making or poised to make a bullish crossover on the PPO. That was the last bullish crossover on the PPO right there. Time before that was right here. So, you can see whether you wanted to be long or short. And these were good trend signals. You got that trend out of that bullish crossover. The one after that gave you that trend, and here we are. So we could easily carry up maybe a back test of this trend line right here and that 108 level. And then, of course, TYX is your 30-year bond yield, and that ran into resistance recently right there as well. You can see it's got pretty decent resistance there and a bearish crossover in play. This is almost looking at, it's like looking at TLT upside down because these are the rates of the 30-year bond. Okay, and I wish I had some more insight or stronger convictions on, the stock market. Just I want to wrap the video up going back to the NQ Nasdaq 100 futures. Remember, we recently broke out of that bullish falling wedge right there. We had positive divergence. And the thing is, I already covered this. It played out to the measured target and then maybe then some. Doesn't mean it can't go up again. If we do, you still have the downtrend line there on NQ. We hit some downtrend lines recently. I pointed out, I think it was QQQ and came very close on SPY, but on NQ we haven't hit that yet. Again, it's probably going to be chop fest, and the best thing out there right now, if you are an active trader, just keep an eye on these very short-term charts. This is that 5-minute chart I like to trade, and it's simple stuff. You just look for divergent lows. You had a divergent low there, you had a rally, and then you had this trend line comes to the left of the chart. There was a breakout and a back test of that trend line, rallied up, put in a divergent high there, at least RSI divergence, and that gave us the reversal. And right now we've been diverging here, aka positive divergence on the 5-minute chart. But remember what Powell says can override especially shorter term technicals. So what I'm trying to say, you have a higher chance of whipsaws and sudden erratic reversals and moves. So if that's not your cup of tea, sit back for now. Wait for, as always, wait for the clear your type of trade, your type of setup, a clearly bullish or bearish chart pattern, or break a support resistance. And trade on the time frame that's commensurate with your skill sets. If you're a part-time trader, you work a full-time job, you come in and try to do this, you're not going to keep up with the 5-minute charts. That's where you want to probably stick with 60-minute or even daily and weeklies. And just a quick update on some of the individual trade ideas. Remember, the other thing that I've suggested recently, instead of trying to trade the markets, which are grinding around, especially if that's not your wheelhouse, is individual stock selection. Long the most bullish, short the most bearish. And Tesla was a short trade idea. We had our first target here recently, and now that was support, and that's been taken out. So that increases the odds we're going to go down and hit T2 now. So I just wanted to give you an update there. Again, that was on this bearish rising wedge pattern, clean up trend line, the breakdown and back test right there. So that one's already dropped about 10% with, should T2 be hit, with about another 7 or 8% downside there. And then, on the bullish side, Intel, that was one of my picks on the long side, still has a constructive chart. If it takes out the low, it may want to put in a marginal new low and still keep those divergences. CRM already hit my minimum preferred pullback target, but it's probably heading lower. Remember, CRM was a long trade. I was bullish here right in the beginning of the year, highlighted that as a top pick. Gave you 2 price targets, T1, T2. T2 was hit to the button last week, in which case I did an update there and told you that even though I had booked profits at T1, I turned around and shorted it at T2, and targeting that trend line, and we're now below that and could very well come down and backfill this whole big old gap right here from last week. So again, it's all about the individual security selection. There's the downtrend line, I'm sorry, the divergence line, negative divergence when that second target was hit. And so if you shorted that, then that's already good for about a 5% profit. And just one last, a new one for you. This one shorted today. Please don't tell my wife. She actually works for this company. But NVO, Novo Nordisk, is a Danish company, leader in diabetes products, medicines, and a big presence here in the U.S. They're the makers of Ozempic and Wegovy, which you've probably heard about. Those are the numerical drugs for weight loss. although I'm not allowed to say that about Ozempic, but I don't work for the company anyways. Wegovy is the one approved. They're the same molecule, and everybody in Hollywood's taking those and losing weight, and that's been priced into the chart. This is where the bear market started for everything else, and Novo Nordisk has run up 110% since then. So due to the overwhelming demand for those two drugs, and they have a pretty well-rounded pipeline as well. But I just wanted to mention that's a short trading up right here. I got a price alert today. It broke that support, so that's this uptrend line right here, and it's been diverging. So looking for a pullback. I don't have these. Well, I'll do it for you now. You probably want to know. These are the potential targets, support levels. 130, just a little north of 135. And this one, I'm going to move that line up just a hair, put it right there, color it up for you. That's 129.63. And if things get ugly, that's all I'd look for now. Again, they can't even keep up with the demand for the drug. That's their biggest problem, and that's a good problem to have. That's what I'd be looking at there. If things get really ugly in the stock market, I could see a move back all the way down here to about 117, in which case that's really good support. That'd be a good buying op. So my preferred target now is to give you about an 8% drop, 7.5. And if things get ugly, target about 16%. And when you break down like that, you just put a stop right above the highs. It's not too far above 3-4%, 5% stop. Keep it in line with your preferred price target. You probably, if you're only targeting for an 8% drop from where we're at now, then you might want to put at least maybe a 4% stop loss, 2-to-1 RR. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.